If you die today, what is the ideal life cover that is required to take care of your family? Please watch this video till the very end as we'll do some calculations in Excel to reach a correct human life value. Disease settlement, or when a client died, settling their accounts was one of the most difficult transactions that I've done as a banker. But death is something that we cannot escape. Sooner or later, we all will die one day. I remember a colleague who once shared her personal experience. She lost her father at a young age of 21. Her mother went in shock. She had two younger siblings. She ran from pillar to post to get the financial matters of her father sorted. Her father had a life insurance coverage of just 15 lakhs. He died in 2001. At that time, if 15 lakhs was inadequate, in today's age and time, not having adequate life insurance can be criminal. So, how much life cover is okay? Is 1 crore okay? 2 crores okay? Well, it will depend on a lot of factors. Just like we take a car insurance, then at the time of the make of the car, what is whether I've taken a hatchback or is it a sedan or the age of the car, the city in which you drive the car, are you taking a third party insurance or a comprehensive insurance? All these factors, all these things will matter in deciding how much will be your insurance premium. Similarly, what will be your coverage will matter a lot, and it is different for different people depending on their social standing, depending on their age, depending on the whether the spouse is working, how old are the kids, what are the other social security net around you. However, generally in finance, we use two approaches. The first approach is called as income approach. Income approach is very simple. It says that let's say your annual income is 25 lakh rupees. The coverage that you need to have should be 20 times your annual income. Why 20 times? The idea is, let's say your annual income being 25, 20 times is 5 crore rupees. So the family will get 5 crore rupees. They can then invest it in any fixed income instrument, right? The volatility of equities may not be for them after the main bread earner in the family has died. So fixed income instruments typically will give you post taxation return of 5 to 6%. 5% of 5 crores would be 25 lakh rupees. You have the corpus will remain intact and the family can take care of the existing lifestyle. Subset of income theory itself is a more sophisticated approach which we shall calculate basis the Excel sheet. Broadly, as a concept, what it does is you'll not keep earning 25 lakh rupees all your life. So if you're 40, let's say, your income will increase by, let's say, the inflation rate 6% every year till you are 60. So it will look at the cash inflows that would have come in case you were there with your family to take care of. So you will calculate the cash flows till age 60 and then do the discounting basis the return on investment that you are looking at. That is one way of using Excel to calculate the actual human life value. Watch this video till the end when we'll cover it in the Excel sheet. Second concept is the expenditure concept. They say that income concept is basically flawed because you don't have to look at income itself because income you are assuming will end at 60. Expenditure concept says that if you have a spouse, that spouse has to live till 80, for example. So your expenditures, basic, at least the important expenditures till the age 80 needs to be looked at. So it is expenditure plus liabilities, both things have to be looked at. So how does that work? You calculate the annual expenditure of the family. You add up any EMIs or some any other liabilities that a family may have, and then basis that, again a thumb rule, you take a 20 times life cover, or you look at the outflows, increase it every year basis inflation, and then discount it basis the kind of return that you wish to make or your family will make after the in eventuality of the death. So these are the two approaches that we have. Few pointers, extremely important pointers, before we move on to the calculations and Excel. First point, if you're taking a life insurance cover of, let's say, 5 crores at the age 40, it will cost you approximately 72,000 rupees per annum. If you're taking the same life cover at the age of 30, it will cost you around 41,000 rupees. So earlier you start taking the financial decisions, bigger benefit you have. But cost of insurance should not be a consideration. What you need to look at is your financial standing. Remember, at age 30, your kids are younger, and if you had, survived till 60, I'm sure if you're already at 25 lakh package at the age 30, you would earn more than 5 crores in your lifetime, right? So please ensure that cost of insurance should not hold you back. Have that one less pizza, but ensure that your family is taken care of. Second important point, which you have to look at, is loans. Retail loans generally have an attachment of life insurance. So whether you're taking an auto loan or you're taking a personal loan or a home loan, your bank or your NBFC will always guide you, tell you that you also take a life insurance cover with it. Generally, life insurance cover component becomes part of your EMI. Let it be. I have seen cases where people felt, no, no, this is expensive. I'll take it a cheaper one somewhere else. And for some reason, the decision may get delayed or it's a flawed decision. As a result, the family suffers. Trust me, after the death of the main holder in the family, you don't want bank or NBFC collection agents calling up your family members. Behavioral finance says that if we automate our financial decisions, sometimes they work out to be better in the long run. So let it be automated, pay that extra amount in EMI, but ensure that you have adequate life insurance along with your retail loans. Third important point, which I don't know how many of you are aware of, Married Women Property Act, MWPA Act. So what does this act say? It says that, you as an individual, you are responsible, or there are beneficiaries, your wife and your kids. They are very important part of your life. So whatever policy that you take, if you're a businessman, please ensure that policy is under MWPA, because as a businessman you may have working capital loans that you have taken, you may have capital loans you have taken, there may be some other liabilities to other creditors, some business creditors, simply business liabilities that you have. If you have taken the policy under MWPA, nobody can touch that policy except the beneficiaries. Even government cannot touch that policy in case there are some government dues that are pending at your end or your business's end. So please ensure that if you're a businessman or a businesswoman, businessmen can take it in the name of the wife or the children, and women can take it in the name of the children. Please ensure that you take it under MWPA. Now let's move on to Excel, where I'll show you the calculation for the income theory as well as the expenditure theory. We will first calculate the human life value basis the income approach. So current annual income, let's say 25 lakh rupees. The proposed age of retirement is 60 years. The current age is 40. First to retirement works out to be 20. So 20 years. Estimated return on investment, I'm assuming 7%. Expected inflation, bullish, it is 6%. Discounting rate. So I had done a retirement calculator, one of my earlier videos, in which I'd shown you basically what you do is you calculate the increase of 25 lakh rupees, the future value of 25 lakh rupees uh, by the inflation rate. And then you discount it, you bring it back at the present value basis the estimated return on investment. Or you can use the shortcut method, that you one plus your estimated return on investment divided by 1 plus your estimated inflation whole minus 1. I've written the formula for you. How did I reach it? In case you missed out while I was calculating, you can always run and rerun this particular video. Estimated human life, we will calculate with the help of PV formula, that is your present value. If you have been watching my videos on personal finance digitally, I mean diligently, by now you would know how to use this formula. So present value, first thing you have to look at, see here's the formula that comes up. The first thing that you need to look at is the return part, and then you have to look at the period. The period would be 20 years here. Then you have to look at PMT. PMT means installment. So here we are looking at 25 lakh rupees, and I'm putting minus because it's a kind of a investment from the customer's perspective. And then future value with there, and type will be 0, which is end of the period. That means the estimated human life value for this gentleman who is 40 and earning 25 lakh rupees will be 4.53 crore rupees. Expenditure approach. Let's say the family expenditure is 15 lakh rupees. Life expectancy of the beneficiary. Remember, we have to look at beneficiary here is, let's say, 80 years. The current age of the beneficiary again is, let's say, 40 years to provide for. In this case would be your life expectancy of the spouse or whoever is the beneficiary. If it's children, then you have to look at children. And estimated return on investment, we are taking it a conservative 7%, and I'm looking at expected annual inflation rate of 6%. We have to calculate the discounting factor. I've already done it. It is 1 plus your estimated return on investment divided by 1 plus return on inflation whole minus 1. And then that will give you an insurance, estimated insurance to cover expenditure of 4.97. If you have any loan outstanding, that will also be added here. Let's say the loan outstanding amount is 2 crore rupees. So the total life cover that you would require in this case, because there is also a loan outstanding, which will be 6 crore 97 lakh rupees. So you can choose either of the two and then use it. It does not matter whether you go with LIC or you go with a private insurance company. Frankly, I have sold as being a relationship manager with Standard Chartered Bank, with UTI Bank, insurance of all companies. And I've also worked in an insurance company. So I'm not favoring any particular company over the other, but ensure that you take enough term insurance. Your policy documents are easily retrievable by your family members. Not thinking about death will not postpone it. It has to happen the day it has to happen, right? But financials, absolute essential in personal finance. You have to look at insurance. That's my message for today. And I hope all of you will remember this session. And if you're not adequately covered, please go ahead and take it. Thank you so much. Do subscribe if not subscribed yet. Do not forget to watch my videos on the financial goal calculators and the retirement calculators that I've already put up. Those videos will help you to understand today's sessions better.